All right. Hello, everyone. Hello. Happy Friday. Thank you so much for joining us for this week's session of On the Grid, which is actually our last session in this event series. So super excited to have you here today. Um, yeah, if you're not familiar with us, this is your first time hearing of us, we're Grid 110. We're a nonprofit supporting early stage entrepreneurs in Los Angeles. And we primarily do this by running no cost, no equity accelerator programs and providing free resources, workshops, all of that whenever we possibly can. So today we are super excited to have Cathyana with us. She is an attorney and the founder of Skinny Tax, and she is here to talk all about tax strategies for founders. So, Cathyana, thank you so much for being here and finishing us off strong with this event series. And I will pass it over to you.
Okay. Perfect. Thank you, Estelle, for hosting and coordinating this entire event. Hello, everyone. My name is Cathyana Jean-Baptiste. I am the founder of Skinny Tax. Skinny Tax is a tax planning platform that allows you to not only do your taxes, but you get a customized personal tax saving proposal. You can do any audit or state and tax liability resolutions, and you can also do any business planning. So you'll get the documents, and it's a monthly subscription that basically essentially does what a tax attorney does, but at a fraction of the cost. And so today we're going to talk about understanding your startup taxes and some of the things that you have to look out for as a startup owner as you continue to scale. And so um, when you're looking at your startup, one of the biggest things that are overshadowed is your taxes. And taxes, having a good tax strategy is essential to growing your startup long term. Often, when you're growing a business as a startup, taxes are often overlooked, but they can have a significant impact on your startup and when you continue to grow and into your bottom line. And so it's essential to have a strategic tax planning strategy at the very beginning, because when you have a good tax strategy and you're saving on taxes, you can free up the capital that you're paying to Uncle Sam and reinvest it in growing your innovation, growing your software, and in hiring more employees. And so understanding what your taxes are, being compliant on the front end can save you a lot of money on the back end with state penalties when you're not paying your taxes or IRS penalties. So making those early decisions to focus on it gives you a long-term benefit that can help you scale compared to other startups over several years. And so I want to start with kind of the basics of kind of what type of structure that as a startup owner, the typical type of structures that you have when you're creating a startup. And so in my line of work, I've seen about five structures when a client is creating a startup. I see a solo proprietorship. That's a good starter structure. It basically is a disregarded entity where your assets, where your profits and your losses are under your individual name. It's a company, but your profits and losses run up to your individual 1040 tax return. And so that's a great way to start a startup when your startup is at a loss, because you can not only use the losses in your startup to pay for any profits that the startup is making, any minimal profits, but it also offsets your W-2 when you have a part-time job and you're still trying to grow your startup. Another version I see that comes out, you can start up with the sole proprietorship. Then usually a startup owner transfers it into a corporation. Usually investors are looking for you to have a corporation when they start investing. A corporation is literally a separate legal entity, and then the profits and losses are taxed at the corporate level, and then you as a shareholder and your investors as shareholders also pay another tax on it. And then, I've seen partnerships, I've seen LLCs. LLCs are a version of a corporation. It could be a single member LLC or multi-member LLC. But generally, if you have one of these structures to begin with, you're fine. You just have to know how to be compliant with it long term. And so, what I've seen with the startup founders is, learning which tax returns that you need to file for the IRS, and then you also need to file for your state returns is essential. And so, most of the startups in this program are probably in California. And so for a solo proprietorship startup, you just have to literally file a Schedule C with your 1040, and then you're compliant. And making sure that you meet those deadlines or filing extensions. The other version I've seen a lot of are corporation startups. They just, you'll file the corporation. You say, hey, I know I'm going to get investments. Let me just file the corporation. As long as you're filing your Form 1120 with the federal, and then you're filing your Form 100 with California State, you're compliant, and making sure that you hit those deadlines. And so those are kind of the basics when you're starting your startup, just making sure that you're creating the right forms, that you're filing the right forms. I've seen startups, they'll file a LLC return with the state by accident, and then they're triggered with an audit or some type of penalty because they haven't pulled the right form. You can easily find those forms on the irs.gov website. You literally type in, hey, I have a corporation. What form do I need to file? And then on California State website, you can literally type in, hey, I have this type of business. What form should I fill out? So they have resources available to you to make sure that you're compliant. And so as you continue to grow your startup, a lot of the clients you're going to get are not only in state, but you're also going to get clients accidentally or intentionally out of state. And so a big thing that I've seen, and so going back to filing your taxes, like I said, make sure that you're filing the right returns. Make sure that you have good records. For example, keeping, your receipts, your bank statements, important documents, and making sure that what you put on the return is compliant with what you have in your records, and then just double checking everything. Making sure that you file the returns, you file the right return, like I stated, everything is above board. You'll be surprised how many people will, put a line item on there, spell their name wrong, or even put the wrong social security number on the return, and it's flagged by accident. So making sure you stay on top of it and filing on time. And then as part of that is once you have a structure for your entity, and then you're filing, you're meeting your filing requirements. The second thing that I've seen is knowing your audience, knowing who your customers are. And a lot of startups, they intentionally start collecting clients in state, but as your startup continues to grow, people start to hear about it. It technically becomes a multi-state startup. And so the next part I usually talk to clients about is your startup multi-state? And the way that we determine that is figuring out your nexus, right? So there's two types of nexus as a startup owner that you should be aware of. One is your physical nexus and economic nexus. They're two different things. So when you have a physical nexus to a state, your startup has a physical presence in that state, whether it's a storefront, you have an employee there, you have a WeWork there, you're physically actively in that state. And then there's another one, it's called an economic nexus that a lot of startup founders are not aware of, is when you're financially in that state. And so what I mean by financially in that state, meaning you're receiving a good bit of revenue from that state. So even if you're sitting in California, 40% of your customers are coming from Nevada, you're technically economically actively involved in that state. So you have to be careful to make sure that you wanted to create nexus with that out of state company. And then when you have that nexus, if you have nexus with not only California, but you have nexus with an out of state like Nevada or Washington or Washington, D.C. or New York, what those states do is they look at things, they have certain regulations where they try to do a long arm and pull you into their state and have you pay taxes to them. And so the way that they do that is they'll do an income apportionment. So basically they'll look at how much sales you have in their state. Do you have any employees that you pay in their state? Do you have any property in their state? And then they allocate for your return, saying, hey, we've noticed that you have business in our state. Is your business subject to income tax in our state? And so those are the things that as a startup you have to plan ahead and know beforehand, hey, I have a list of clients. Where are these clients coming from? Where are their addresses? Am I attaching myself to somewhere like Wyoming unintentionally? And you have to make sure you're staying on top of that. And the way to do that is always looking at, what that physical nexus is, looking at your clients' addresses, kind of getting a feel for where they're ordering from, and figuring out for that particular state, if you have more than like, 8 to 10 clients, this is when you should start to look. If you have more than 8 to 10 clients from a certain state, you start to look at what are the physical nexus rules for that state, what are the economic nexus rules for that state, and do I fall into one of those? And if you have no intention of trying to pay taxes in those states, then you got to come up with a strategy saying, hey, I don't know how we're reaching that market, but maybe that's not a market that we want to cater to. Let's figure out how they're even getting to our ads. And so I've seen a lot of startups that are multi-state and you're not aware of it. So that's one of the first things after you create your business, try to figure out what is my nexus, where are my customers coming from? And then I think I talked about this, knowing your how your business structure affects how income is apportioned. Like I stated, if you have nexus with a state, they're going to look at things like your sales, your payrolls, and your property to say, hey, you have this much in our state. This is how much you're going to owe us long term. And that's usually for corporations. They'll take a hard look at corporations that they think are doing business in their states. For pass-through entities, they'll come after you, for example, like your LLC, S corporate partnership. They will look to you individually. They'll say, hey, it looks like this guy has been in our state or is doing business in our state. They have a pass through, so the owner themselves are technically liable for any taxes in that state. And so the way you stay compliant, if you think you've triggered a multi-state nexus, is making sure that you look at any sales tax or sales and use taxes in that particular state. And you can do that by reaching out to, you literally put in California Franchise Tax Board. You can, and then it's usually the Franchise Tax Board for every state. So Wyoming Franchise Tax Board, New York Franchise Tax Board, they will tell you, what the rules are for Nexus, physical and economic, and they will tell you if there's a threshold that you have, if you meet for them to be taxed in their state, if you reach a certain a certain amount of sales in that particular state. And then if you're a startup that are selling tangible goods or digital services, I would be very, very adamant about checking because you never know where those things are going to be sold. If you have online customers, you never know where they live. So you are one of the primary candidates to end up with a kind of a multi-state nexus without even knowing. Um, and so if you're not keeping track of that, you will eventually get a notice from the state that thinks you have nexus with them, and then you have to pay them the taxes. And sometimes, for example, you'll have a PO box or a mailing address on file for your startup. They've mailed out a letter to whatever to the last filing that they've seen on your federal return, and you never get it, and then you have back taxes of about 10 or 20K for a state that you never know you had nexus with. So it's always good to double check and make sure that you don't have nexus with multi states. And so, simple way of tackling this: if you're a new startup, I know it can be overwhelming trying to keep track of what states you have nexus with. An easy way that I tell clients to keep make sure that they're compliant is getting an app. So getting any type of payroll app or sales app that literally they've automated the process of keeping track of where your customers are buying from, or they've automated the process of where you're hiring your employees. And so they've already put those structures in place to make sure that you're compliant, and then they keep track of, hey, you have 10 customers here, here's the filings that you have to do, or here's what you have to pay them in taxes. And so one of the easiest ways is using apps like Gusto, ADP. If you're hiring people and they're from other states, another app is Upwork or Fiverr. Those apps do all those tax compliances for you by state, and they notify you when you've triggered nexus with a specific state. All right. Um, And so a lot of certain taxes can be triggered with Nexus. And the reason why it's important is that some states have additional, aside from sales and use taxes, they have other certain taxes that are triggered for different reasons. For example, some states have franchise taxes, and that is not based on yourselves, but it's based on your business net worth and capital. So if they think that you have nexus in their state, like states like Delaware or Texas, they can say that you have to pay them taxes, not because of the sales that you've made there, but they can say, hey, your company is worth $3-4 million. Technically, you owe us a portion based off of our franchise tax rules. And so you have to be careful that you're not triggering a tax, not only for sales, but also for other ways that they create nexus. Another one is gross receipts tax. Some states, they base it not on your profits, but on your total revenue. So even if you have expenses, they look at, what you've collected throughout, the entire US, and they say, hey, you've made this much, even though you're at a loss, you still owe us taxes. So there's always ways for them to kind of their goal is to stick to as many people as possible to get more revenue to pay for the infrastructure. So just be careful to make sure you're not, putting your arm in a jar and getting stuck with a tax that you weren't even aware of. Um, but there's always some good things with having Nexus, right? So it's not all negative. If you have customers in multi states, that's a good thing. You're growing, you're getting national attention. You have to be careful with those taxes, but there's always ways. There's a good side. So as part of their incentives, so some of these states want you to stay in their state and grow there, and so they'll give you state tax credits and incentives to be like, hey, you have a few customers here, you owe us the tax, but if you grow in our state, we'll give you bigger incentives, right? And so states like Wyoming, Nevada, Delaware, they have incentives when you start to grow. And so if you have nexus with the state, start to look at their R&D credits, or start to look at their job creation credits and research opportunities that will give you a tax deduction. And so growing in that state, if it's intentional, there's always some benefits there. All right. And so looking at the research and development tax credit in certain states. And so R&D tax credits are basically an incentive to promote innovation, and then as a benefit, they give you a tax deduction or a tax credit. What they want to do is in that state, there's usually different projects that they want to find an efficient way to get it done. They want to have businesses focus on some of the local city problems that they have, whether it's how to make it more efficient for affordable housing, how to make it more efficient for clean water, et cetera. They don't have the bandwidth to create those projects. And so what they do is they give research and development tax credits to small businesses or startups like yourself as a way for you guys to implement that as part of your company or do research on some of the city problems, and for that, they give you a tax benefit if they know that you're doing that kind of work. And so most cities, you're eligible as a business for these tax credits if you're engaging in developing and improving any products, processes, or software that might be helpful for that city or that state. If you're employing engineers, developers, or scientists or technical staff that are working on a research project that might be beneficial for that state, or as a startup, if you're operating in industries like manufacturing, life sciences, or agriculture, usually things that the city or the state is looking for, startups that are helping them grow and sustain for the local citizens. And so if you have a project, even if it's a small project that's not your main source for the startup or your main goal, but it is something that you can literally help the local city or state with, you can reach out and say, hey, I'm doing this project. I have research on this. Am I eligible for a tax credit? And then so some of the tax credits that I've seen that have been very beneficial to startups are there's one called the federal tax credit. So this is on the federal level. So if you're doing any type of qualified research or development in your state and you're actually trying to do the research or build something that might help your state or local city, there's like a 13% qualified research a federal credit that you can apply for when you file your returns on the individual level or for your corporation or LLC or S corp. That's a big one. That 13%, even if you're doing a small project, can be very beneficial to offset your income. I've seen for the state tax credits, over 30 states, they offer their own R&D credits. I know, for example, in California, specifically in LA, they have a significant amount of research credits for different projects. They list it on their main website. They even have a credit where they provide you with employees for your company if you use them for a certain amount of time on a specific project that they want to do research on. And then they pay the payroll. Um, Another benefit that they give is the startup payroll tax offset. So, for example, if you've been a startup for less than 5 years, you've made less than $5 million in gross receipts, you can apply for up to about 500K per year in credit to offset your employees' payroll taxes if you are doing something that they consider research and development. Another one is qualified expenses. It includes, any wages that you've paid to an employee. For example, if you hire an engineer, they're doing like 80% working on your startup, but they're spending 20% developing a project that might help with clean water or energy, for example. You can literally get a qualified expense. You can deduct their wages up to about 65% of what you're paying them because they're doing some type of work that might help the city or the state. And so there's a lot of benefits to really dig in when you're creating a startup to look at the local research and development tax credits. All right. And if you're interested in using those tax credits, when you apply for the state or the local ones or the federal one, when you're filing your returns, you would just file a Form 6765 to show why you're eligible for that credit or expense. And if you're doing the payroll offset, you'd file a Form 8974 for federal to show, hey, I've taken advantage of this credit. This is why my taxes should be lower because I'm eligible for these credits. All right. And so in addition to the research and development tax credits, there's some other specialized deductions that I always recommend to startups that you can take advantage of. One of them is simple. Right when you start the startup is a startup deduction for just creating it. You get $5,000 up front. Even if, for example, you don't use the entire $5,000, you can spread it across the life of your startup. Another one that I always encourage clients to take use of is the Section 179 expense deduction. Essentially, you get a deduction as a starter for purchasing qualified property. So things that will help you grow your small business and your startup, like your laptops, software, anything that you use to grow your business, you can take a deduction off of it. So, for example, if you have a group of employees and you want to buy them iPads and it helps grow your business as a startup, you can take a deduction off of that and list it as an expense. Um, Another one is your business interest expense deduction. As a small startup, you're taking out loans to keep afloat. You're taking out credit cards, et cetera. Whatever you need to do to continue to grow. The way that they help you with that is by giving you an interest deduction. So if you have a loan, if you have a credit card or anything that's helping you stay afloat, you can deduct the expense of the interest on that loan on your tax returns. And I think that's very, very beneficial. Um, and then the qualified income deduction, like if you're a pass-through entity, like a sole proprietorship, partnership, or S corp, you can deduct about 20% of your qualified business income against your taxable income. So these are things that, as a startup, the first thing I tell people when they start that year is literally make a list of any potential tax credits or deductions that you can be eligible for and take a stab of trying to qualify. As a new startup, if you're making less than like 1 million or 2 million, you should be paying the bare minimum in taxes because there's so many deductions or tax credits available that it should offset any profits that you're making they're out there. They're not going to advertise it, but there's like thousands of deductions that we can take for very small expenses that you have to deduct any to offset any profits that you're making for your startup. All right. And so, do you have any questions so far on that portion? I'm going to switch over to kind of some other tax issues that I've seen for startups. All right.
So I have a question for you because I've always, every time I've heard like tax credits and things of that nature, I always thought, well, like I'm not Elon Musk. I'm not doing millions of dollars in like I'm small. You know what I mean? Like we may do, I'm trying to get to six figures in revenue. So if I'm a company and maybe we are not, we're not huge, we don't have tons of revenue yet, what should I be thinking about in terms like, am I too early to be thinking about tax credits and all of those things? Or um, should I, like, where should my mindset be if I'm kind of in that stage?
Yeah, no. So the earlier you are, the more you should be thinking about tax credits. So even if you started your startup yesterday, you're still eligible for tax credits. As long as you are trying to build something, you're still eligible for tax credits. So even if you're making $1,000 a month for your startup, you still qualify. It's not about the revenue, it's what are you doing to help them get to something to make their lives easier as a local state or local city. For example, there's a research development credit program for the local DMV. They want to find a startup that will help automate the way that people renew their driver's license. It's they need help. You don't have to be a big startup or a big business. They just need some guy to create a startup that will help them automate it. So you should be thinking about it right when you create it. Actually, as you get bigger, you get to that, that big, you start from a startup, you get into like you IPO or you become like a multi-million-dollar company. It's a lot harder to say that you are focused on research and development because you're $1 million company focusing on customers. So, this is a field that startups should take advantage of because they're usually the people that they're looking for at a very early stage.
Yeah, I've heard oh yeah, questions are coming now. I think I understand what you mean by this term, but I think because we have so many different types of entities in here, when you say startup, are you specifically only referring to I'm building a SaaS product, or do you use startup interchangeably as like other types of businesses? Can you clarify that as you've been talking?
Yeah, yeah. So the way I view a startup is a company, whether it's a corporation, a sole proprietorship, or someone like a law firm trying to automate their process, as a company that's trying to grow and get investments over time and then eventually be sold or IPO. That's what I consider a startup. A small business is something that I consider they're not looking for investments, but they want to just grow their revenue every year. And so I think people consider startups as like software AI. No, anything can be a startup as long as you eventually want to have investors or VCs or anyone involved in an IPO or get acquired. That's a startup. A small business is the guy who wants to start a company and just make solid revenue, but is not looking for investment long term or anything like that.
Awesome. Well, thank you so much. So it's more so about exit strategy than it is with how the business is some of the other things. Really great question. I came to this today. I learned about this today. Oh, shoot, we've been doing this for the last 3 years. Can these credits be retroactively applied? Like, we did this in 2020. Can we go get those tax credits? Or it's a great question from Jay. Jay asked that question in the chat. Jay, what's your business? Type it in the chat so we know what do you do?
Yeah.
Currently on the road, but I can chat virtually. I'm in entertainment specifically. I create like real life video games or escape rooms.
That's great. That's great. That's great. Yeah, that's a great question. So it's based off of how far back you can amend your returns. So right now you can amend your returns up to about 3 years. So if you have tax credits that you didn't take advantage of, you can literally take that old return up to about 3 years, have it reviewed and send it in and get it amended. And then they will retroactively send you an additional refund for the taxes that you've already paid. So that's a great question.
I have one more for you before you move on.
Mhm.
Uh, it seems my wife worked for a startup that specifically was helping like large manufacturers get tax credits. But what I'm finding is that for some communities, this conversation is happening retro. Like we already started the company, and now we're trying to learn about these tax credits. For other companies, tax credits and these type of things are actually part of their strategy. It's part of their like they built that into their defensibility and their moat. So who typically are you seeing as the like? Can you talk a little bit about the founders that you've been working with and like how they've been thinking about and incorporating this into their overall like strategy for growth, etc.
Yeah, that's a great question. So typically, the startup that come to us are usually the ones that are start to make money to be taxed. So, for example, they start to make 120K to 200K in revenue, and then now they're hitting a huge tax bill. They're like, oh my God, we're getting a huge tax bill. How can I reduce it? Right. So that's usually when they start to come to the tax professionals when they're seeing that huge tax bill for more than a couple $1,000s and they want to reduce it. And so now we give them a tax credit strategy. The startups that I've seen do the best are the ones that come to us right when they file for their companies. Literally, like, hey, I want to put the strategy together now to move forward. Those are usually the ones that fare the best. The ones that come to us, after they've created their startup for more than 2 years, they'll come before they start making some real profits. They fare the second best. But generally, people come to us when they start making some real money, which is honestly a little too late. You should literally come to us when you create your startup.
I'll yield my time to the floor. Uh, thank you so much for answering the questions.
No worries at all. And so the next topic I'm going to talk about is kind of what I've seen when startups get involved in cryptocurrency. So I wanted to touch on this a little bit. One of the biggest pitfalls I've seen is when I know cryptocurrency is hot right now. It is kind of the wild, wild west, but as a startup, you have to be careful in the way you're using it. For example, if a client wants to pay you in crypto, if you have crypto as part of your business, you accept it as payment or you're using it as payment, you have to make sure that you're tax compliant, right? And right now, no one's really checking on it. No one's going to be knocking on your door, but it is something that they're actively working on to kind of double down on. And so, as a startup, when you're selling crypto for cash or you're exchanging Bitcoin or you're switching the Bitcoin to other crypto like Solana, you have to make sure that if there's an increase in value or if there's a sell to cash, it does trigger capital gains and you are subject to taxes. And so what I've seen is, those softwares like Robinhood or some other ones, they'll give you a portal and you're doing all these movements, but they're keeping track of your transactions and they'll report it to the IRS or the state. And then you get a bill 6 or 7 months later saying, hey, you owe this tax, or a couple years later, and you didn't even know that you were triggering capital gains tax. So as a startup, just when you're dealing with crypto, start to look at what your liabilities are and request tax forms. Hey, I did this transfer or this guy paid me with crypto. What am I liable for? I think someone raised their hand. Um, sorry, I can't see
Yeah,
anything.
it was Erica. Oh, by accident. Okay, Erica said no.
Perfect. Yeah, and so even if you are, you get crypto, and forgive me, I'm kind of old school. If you're taking crypto and you are going to go buy a gift card with it, or you're buying a cup of coffee, it still has value, and it might trigger a tax that you're unaware of. And so what I tell people is, with the crypto, where are you getting it from? When someone's giving it to you or you're selling it, you have to keep in mind of is there a short-term gain or is there a long-term gain? So if you're receiving it, you ask the other party, how long have you had this? Do you know that you're subject to capital gains tax up to 37%? Have you taken care of that before you give it to me? Right? Because even a gift from someone is still considered, taxable. And so if you have crypto yourself, you have to keep in mind before you transfer it, do you have it for a year or less than a year? If you have it for more than a year, then your tax liabilities are less. So you have to kind of keep track of it, even though there's no one actually keeping track of you. Yes, I see the raised hand.
Christopher asked in the chat, and this is, I think, is a common thing for a lot of entrepreneurs. I actually don't want to show that I made tons of money. So I made zero. So how do we deal with these? And I know, this is being recorded. I know you're not giving tax advice and you're not telling us what to do. But we made zero revenue the first year. How do we deal with tax credits, deductions, those type of things when you don't have any revenue?
That's a good question. So even though you don't have revenue, when you have losses, you have to think about it as you're harvesting your losses. So there's this thing called carry forwards, right? So if you have like 30,000 in losses in 2024 and you have no revenue to offset it, you can carry the loss forward to the following year and forward to up to about 5 to 7 years. And so when you have losses, it's still beneficial to say, hey, I have these deductions in place, but I have like $1,000 in profits, but I have 40 in losses. You still want to show that on your return because next year, if you do have profits, you can use the losses from the prior year to offset those losses. So harvesting losses is profitable in and of itself because some companies will literally sell their companies with harvest losses. So to a profitable company, because that has value. If this company is making a million or two, you have like 300K in losses, they can acquire your company and take those losses to offset their profits. So it's valuable to keep track of it. Perfect. And so the way that you keep track of cryptocurrency is is treated as property, right? So it's just, I know it's virtual, you still have to keep track of it. Even if someone's sending you 1 or 2 Bitcoins, I know it's probably like very expensive, it's still very profitable and you have to treat it like an asset. And so even if the transaction is small, report it. I know it's a pain to report if it's $1,000 transaction, you have to report it because somewhere that software that you're using, they're going to report it eventually, and the IRS is going to double check that you reported it. And these audits can be several years from now. And so you just want to make sure you're putting on the front end, paying the money, and keeping sure that you're keeping track of any crypto transactions. And so the first thing that you have to do is ask for those 1099s, ask for those tax forms in the portal. Reach out to the customer service on Robinhood and say, hey, I know I had these transfers. Do you have like a list of transfers that I made for the account? They will send that to you and then you'll report it on your returns or your business returns. All right. All right, so I'm going to switch over now to another topic is, do you have any questions on crypto before I move on? Okay. So another topic I wanted to touch on is, as you continue to grow your business, you might not have the revenue to hire, really talented employees or have the budget to hire, more senior employees. But one thing that you do have in value is stock options, right? And so if your company is something innovative and you know that you're gonna grow, some people will join your team, not based off of the revenue, like really low salary, because they have the options to acquire some equity in your startup. And so it's something that I always tell startups, if you want the best of the best, or you see someone in your industry that you want to work with and you can't afford them, don't give up on that. Reach out to them, say, hey, I know you are an executive here, you have 20 years of experience, I can't afford your salary, but can you be a fractional person for me, a fractional CTO or a fractional CMO, and I can give you stock options? And some of the things that I've seen on the market is the incentive stock options, the ISOs. It's a way of equity compensation. Basically, it allows the employee the ability to purchase company shares at a certain price. So right now, you're growing. Here's some stock. Eventually, as we get new investors, this will grow to tenfold, right? Another one is a non-qualified stock option, which allows the employee to, buy into your common stock at a certain price for now. And then as they continue to grow, they grow from the date of purchase, and then it continues to appreciate. I've seen a lot of fractional senior executives, take on work with young startups, even if their salaries are usually, six figures, they'll take it for like less than a fraction of that because they have the option to take on stock options. And so that's something I tell startups to take a look at. Look at the tax consequences when you're giving it to the shareholder, when you're giving it to these potential employees. But it's a very good incentive when you're trying to recruit, really top talent in your industry. Right. And then there's some other ways that you can kind of recruit and then provide equity compensation. Some of them are called restricted stock awards or restricted stock units. They are different from the other two options, but they have their own tax treatments. When you're giving out these incentives, just make sure that you're staying on top of it. For example, your restricted stock units, they are subject to ordinary income based off of the share value when they vest. And so when you're giving out these options, make sure that you are giving them the right treatment and not just saying equity. So if someone comes out to you and say, "Hey, I want to recruit you for some equity," make sure that you're when you're giving those contracts out, you know exactly what type of equity you're giving, and then the tax consequences are relayed to the employee. All right. Okay. And so if we don't have any questions on that, I want to touch on why it's important to tax plan when you're fundraising, and then also when you're exiting as a startup. Tax planning is usually not in the forefront of when you're fundraising. You're thinking about, hey, I want to land, that VC, I want to land that angel investor. You're focused on pitching. You're focused on trying to acquire the money. But part of the biggest incentives that I've seen when working with, VCs, et cetera, is they're looking at, do you have a tax strategy? Like, are you a business savvy person that can maximize the investment I give you and not pay an arm and a leg to the IRS or your local state? They care about that. And so when you're pitching your startup, one way of impressing these investors is saying, hey, not only am I going to use your money for this, but I've already looked at the tax consequences, and I'm going to make your money turn into threefolds without spending too much on taxes. And so some of the ways that these investors are looking at taxes, they're looking at your equity structure, for example, right? So if you come in, if when you're fundraising, some of the things that they're going to ask for is, what type of entity do you have? Do you have common or preferred stock? Do you have option pools for your employees? Because they're thinking, hey, if I invest this money, how much is it going to go to this, to taxes? Are you familiar with the tax rules for that particular structure? And then where is the profits and losses going to be allocated? And so they're looking at that. And the other thing that they look at, and they're not, really outwardly telling you, is, are you taking advantage of your R&D tax credits, right? I had one client, for example, they're pitching to a company, they're pitching to a VC, and they're like, okay, we've opened an office here in California, but we're also opening an office in Alabama. The investor's like, why are you opening an office in Alabama? They already had they're giving us a tax incentive to open in a rural area like that. We're getting 20K in tax credits or this and that. The investor was impressed because you're not only looking at, how you're going to get their money, but you're looking at ways to, enter another market and be tax savvy about it. And so when you're doing that, to them, they're saying, hey, you're reducing your taxable income by focusing on those R&D tax credits, and you're increasing the way that you're using their investments to grow your business and your software. Um, and then, as part of that due diligence, they're also looking at, are you aware of your qualified small business stock, knowing what that is when you're pitching. Part of that benefit is, as an investor, they can exclude up to 100% of their capital gains if they invest into your startup and they sell it out and they hold it for about 5 years. Is that plan being pitched to them? Are you actively letting those investors know that you have that option with the qualified business stock, saying, hey, if you invest 100K into this, if you hold it, if you decide to sell it in 5 years, the capital gains of the appreciated value of your equity will not be subject to tax. That should be part of your fundraising. Um, and then so in addition to fundraising, it's also beneficial when they start to ask you, hey, if I invest this money, are you looking to get acquired over time or are you looking to IPO? Part of that discussion, tax should be involved. So it's always good to know what your long-term goal is. Generally, with a startup, it's always good to be acquired, but I know the majority of us are trying to IPO eventually, right? But knowing the tax strategy for both and providing that information to the investors is also beneficial and also beneficial for you long term. If you have other competitors in the market and you know that they were acquired for this amount of money and they were subject to this amount of tax, start to plan around that. Have a plan around that. If I'm acquired for this much, how much am I paying in taxes, right? For example, $3 million might look great as a new startup if you're acquired in 2 years from when you started it, but then it's eaten up with 37% in taxes. So you end up with, 40% less and on top of the investments that you have to pay back. So are you really getting anything if you get acquired at 3 million or 100K or 200K? So knowing how much you'll pay in taxes when you're acquired or IPO is a good way to have it's a good way to grow your business and know, hey, what's my threshold to even consider that exit when I'm looking at potential acquisitions. All right. Do you have any questions on that?
There, not on that, but there was a question that Jay dropped as you started talking about employee stock options, things of that nature. I have my own thoughts on the on this question, but you're the expert, so we'll put you in the hot seat. Jay wants to know. Obviously, startups have like equity stocks and all of those things to leverage as like additional leverage to pull for compensation. If you are not a startup, you don't have equity stock, employee stock options, what are some other ways that I can get some folks to come in and get them to work if we don't have that much revenue? We're a small business. We don't have that much revenue. I can't give you these stock options. What can how can I incentivize them to come do some work for me?
Yeah, so other strategies that we use is you work for a little bit about like staggered salaries. So you do a plan where, hey, we're gonna start you off at this amount, but when we receive this much in investments or we receive this much in revenue, we're gonna increase your salary by this amount. And so that's one way I've seen people incentivize fractional executives. Another way of doing it is giving them a way of reducing their tax liability individually. So an executive at a big company like Microsoft or et cetera, they're making 300-400K in salary. One way of saying it is, hey, I have a startup, we're at a loss right now. If you work with us, we can set up a structure where you're taking on some of our losses on your W-2. So that's another way of doing it. Generally, the salary increase plan is usually one of the best ones I've seen. If you don't want to give equity, sometimes people just want to have board seats on your startup just to leverage their reputation in the city or in the market. And so another incentive is saying, hey, if you work for me as a fractional member with a very low salary, you can list yourself as a board member of my startup and kind of like shop it around for a paid board member seat at a bigger company.
Wow, you're good. I, I'm sure you're gonna get to it. We got 10 minutes left, but I would love to just do this softball lob to you. This all sounds great, but I didn't get into business to worry about tax credits and all of that stuff. This is what you do, right? I'm assuming with Skinny Tax, right? Like, how does Skinny Tax help founders in this way?
Yeah, so this is what we do. So for example, we usually have you guys start up with a very we're subscription based. So we are all tax attorneys who've decided to create this startup and give this to you at an affordable rate. So what we do is when you join our team, you're given a portal with one of the tax attorneys or tax accountants, and then we come up with a tax strategy for you, a customized plan. So if you started your startup a year ago, if you started your startup yesterday, if your startup's 5 years old, we go back and try to come up with a customized proposal for where you're located, what type of industry you're in, and literally list out the tax credits, the tax deductions, and we handle all of the tax return preparations. And then we also monitor and represent you for any audits with the state and local city, and we also represent you for the federal IRS. And part of that is, and in addition to that, we also provide you with any documents for the tax planning. So, for example, if you are a tax startup that wants to donate or use charitable deductions, we'll draft the documents necessary for you to take that deduction, and then have it ready if you're ever audited. And so, what we are essentially, like the tax legal Zoom, for example, at just a very affordable rate on a monthly basis. Um, all right. And so essentially, the ways to keep track of it, even if you're on your own or using a group like ours, is making sure you stay compliant, right? You should be talking about tax on a weekly basis. I know it's not something that's fun, but this should be at the top of your mind on a weekly or bi-weekly basis. Keeping your documents accurate and organized, understanding your tax deadlines, implementing an internal control. Even if you have one person looking at it every 2 weeks, having a tax meeting, having regular reviews. You should be thinking about tax on a week to week. April 15th should just be the Super Bowl. Like, you should be ready to go. It shouldn't be the first time you're thinking about how you were, what your tax liabilities are. It should be on a month to month basis where you're actively planning. So when you submit that return, you're coming out with the lowest tax liability level ever. So this is what I did for a living. My job was to get these high net worth clients, these Fortune 500 companies, these family offices at the lowest tax bracket when they filed. And there was nothing that the IRS or state could do about it because we've been planning it for the entire year and we had a strategy in place. And so, kind of keeping that at the top of mind and having like a meeting where you're always kind of keeping track of what you're doing as it relates to tax. And then the last portion I'm going to open up to questions is kind of one of the biggest things is what we do is that we keep track of the recent tax law changes. If even if you spend 5 minutes looking at current tax laws in your state or in your local city or federal, they're always coming out with some type of new credit or some type of deduction that might be beneficial to you. I know with the administration, there's a lot of talks around the Tax Cuts and Jobs Acts. Actively monitor that. How can you benefit from that new tax law change? If they're trying to decrease taxes for corporations, figure out when. Is there anything that you can qualify for? And so keeping track of that is very, very beneficial. I know there was one tax credit that was available for like 6 months in LA. People didn't take advantage of it, but I kept track of it. So just keep track of it because they're always coming out with new tax laws that can benefit you. All right. That was